Hi, my name is Mark Panett, and on behalf of Junior Achievement, or JA, I'd like to thank all the teachers and students for letting us into your classroom. Junior Achievement Programs and JA is a nonprofit global organization with the goal of helping youth develop financial literacy, get ready for the workplace, as well as learn a little bit of entrepreneurship. Myself, I participated in JA when I was in high school, and it was a fantastic experience. And all throughout my life as a financial planner, I've learned about finance. I value the experience of entrepreneurship I learned from JA, and I'm here today to share some of my experiences with you. And today, we're going to talk about becoming investment wise and what that means. So it's a very important topic and a very exciting topic. So it can be considered a little difficult to save some days. With all of life's expenses, saving sometimes is a little bit hard. But think of it this way, and this is the value and the advice I give people is don't do it all at once. Start, if I can give a baseball analogy, look at it as like hitting singles. Is do a little drop in the bucket of your savings bucket every month or every 2 weeks when you get a paycheck, and it will build over time. Don't try to save all at once because you want to minimize the stress of that task, and saving $25 a month is a lot easier than saving $5,000 all at once. So in your dollars and cents workbook, there's information on different types of investments. And investing is basically putting your money away so that it will grow over time. Some investments are riskier than others, and each person has different tolerance to risk and what they feel comfortable with. So it's very important to know what you're investing in so that it doesn't add money stress to your life. One of the vehicles that you can use are called GICs, or Guaranteed Investment Certificates. GICs are a very low risk strategy for saving. And when you get a GIC, the bank or financial institution will guarantee the amount of interest you will get, and at the end of the term, whether it could be a 1-year GIC, it could be a 5-year GIC, terms vary, you would get your principal back as well as the interest earned. Now there is a risk, of course, if you need that money in before your term expires, where you could lose on some interest and some fees, but that is generally how a GIC works. Now you also have mutual funds, and mutual funds are like a big bucket of money, where I put my money in, you put your money in, and everybody puts their money in, and investment professionals invest that money for you. It's one way of diversifying, which means you're not buying just one stock or one bond. You're buying a whole basket of bonds, which is a lot less risky than just going for an individual investment. And I said bonds, and I said stocks. Let's talk about those for a little bit. Stocks is you buy a share of a company, and you own a little bit of that company. And if the company does great, the price for that stock tends to rise. And if the company doesn't do financially well, then you could have a loss on owning that stock. So overall, you're going to get a lot more fluctuation in stocks than other investment vehicles, but you would have an expected higher return over the long term, and that's not a guaranteed return. The other aspect you could invest in are bonds, and you might have heard that term around too. But there's not as many headlines about bonds. And here's the important thing, is you're going to have stocks in your portfolio when you get older and you invest for retirement or other goals, and you're going to have bonds in that portfolio. Bonds, traditionally, although not always, do fluctuate less than stocks. Now, what is a bond? Well, let's say my name is Mark, and the government of Canada needs money to build a highway. And they could use their own money, or they could issue a bond where individuals like myself or corporations and everybody invest in that bond. And it could be a 10-year bond, which means I lend my money to the government of Canada, they pay me interest rates along the way, and I make a little bit of money, and at the end of that term, the bond pays me my principal back. So you become a borrower. You borrow your money to the government of Canada. But guess what? The city of Halifax can issue bonds. The province of Nova Scotia can issue bonds. Corporations can issue bonds if they want to build infrastructure. A company like Apple could issue some debt, and companies lend their money, or companies or people lend their money to Apple to build their infrastructure. The important thing to realize is that the lower the risk, the lower the return. So lending your money to the government of Canada, not really risky. So you're going to get a lower return on your bond than if you invest your money with a corporation, traditionally. So think about that next time when you're investing and how much risk you want to take regarding your investment decisions. Saving money is about having money when you need it. And I've repeated that to many people over the years is don't take too much risk. Make sure when you need the money that it's there for you. And when you talk about long-term planning, there's different types of investments that you can do. So always tailor your savings with the proper investment for the time horizon that you're investing in. Now, there's different programs available that do offer advantages to Canadians. And you might have heard the term TFSA, which is a tax-free savings account. You might have heard the term in advertising of RSPs, which is a registered retirement savings plan. And your parents might have started or have an RESP for you, which is a registered education savings plans. And the important part about TFSAs, RSPs, and RESPs is these aren't investments. They're vehicles created by the government to encourage Canadians to save. And they do offer different advantages. So be aware that these investment vehicles exist and you choose the investments that go inside of them. Little piece of advice as you head into the real world is pay yourself first. Now, what does that mean when we're talking about pay yourself first? Is when you receive an income, put some aside for yourself first. Because if you wait till the end of the month, till you've done all your variable expenses and you've gone out to the restaurant, there might not be money left. But if you do it at the start, when the money comes in, it becomes a non-issue over time and just becomes part of your lifestyle and creates a great financial habit to assure that you have money saved up for emergencies, short-term, medium-term, and long-term. If you're interested in learning more about savings and investing, you can visit jacampus.org for more programs on financial literacy, including JA's Investment Strategies program. And this is a great one. This teaches you about the stock market, buying and selling stocks, and it has a national online stock market competition game that allows you to buy and sell stocks in game situation against thousands of teams of students across Canada. This program can be done by your teacher for your whole class, or you can do it as a self-directed version on the JA campus. Thank you for listening, and I hope you set yourself up for good financial health now and in the future. Thank you.